Welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton, the Inflation Guy, and I am your host. And today on the podcast, we talk about the CPI report for this month. And the title of the CPI report is just ugh, or oof, or yow, or something to that effect. Pretty interesting, kind of crazy, kind of ugly report. I always enjoy the CPI report day, and for different reasons. I mean, I used to enjoy it because that's when the most exciting trading for an inflation guy happens, is on inflation day. But there's not a whole heck of a lot you can really do. You know, the number comes out and the prices of stuff move kind of to where they should be pretty quickly. And it isn't necessarily super liquid, but I like it now because for a different reason, and that is because on this day, I get more hits to my blog. I get more hits. That's the Inflation Guy blog. I get more hits to the Inflation Guy podcast than any other day. The CPI report podcast is my most popular podcast of the month. I do some other good stuff. You really should look into it. But it is sort of fun. I get a lot of emails, obviously, a lot of Bloomberg chats, a lot of calls from people, wanting to know my 2 cents. And occasionally I get on earned media. But anyway, it's a good day. And that's whenever CPI is interesting at all, and it can be interesting up, it can be interesting down, and we'll get to that in just a second. But first, a word from our sponsors. This episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of alternative ETFs solving today's most pressing portfolio challenges. Not only do they have sophisticated diversifying strategies like a managed futures ETF or yield curve plays like TUA, they also have the number one best-performing intermediate core bond fund from 2023. That's AGGH, and they also have an enhanced income ETF, HIGH, that was in the top 2% of its category. So they have a lot of great ETFs, a lot of good-performing ETFs. You should check out their website at simplify.us. You can find their entire lineup of ETFs at simplify.us/ETFs. This podcast is also sponsored by Enduring Investments. Imagine if you could be a hedge fund investor or a pension or wealth management CIO 35 years ago instead of in 2024, with all those inefficiencies that persisted before they were exploited and arbitraged away by high-frequency trading. The opportunity set for alpha was rich and persistent. Well, there is such a market that today has those characteristics, and it's the market for inflation-linked and inflation-adjacent instruments. Now, if you want to exploit those opportunities today, you need someone who exists on the cutting-edge frontier of understanding that market. You don't want to assail Everest without a Sherpa. To explore these opportunities in different forms, including long-only, hedge fund, or a factor overlay recognizing embedded bets in a core strategy, you need an inflation Sherpa. Enduring Investments is your inflation Sherpa. Visit us at enduringinvestments.com. Thank you to the sponsors. And so we get to the report now. So as I said, it's an exciting day, and it's exciting even though, I said in last week's podcast that I thought this number was going to be weak. I thought it was going to be softer than the expectations. Now, over the week, the expectations from the street had been coming down towards me. They were getting a little softer. Notable outlier of Goldman Sachs, who pretty much nailed the report, but everybody else was kind of coming down. And so we went into the report with the consensus for headline being 0.16 and the consensus for core being 0.28. And I was still a little bit below both of those. And whoops, the number was anything but weak. This is the reason that it is a bad idea to choose the length of look back or the moving average period or whatever that allows you to tell your story the best, rather than picking, a look back period, year on year or month on month or whatever, that you kind of consistently go back to. And you can explain deviations from that. Gosh, the year on year was up today, because of this base effect and whatever, and we should look through it. But saying, hey, wow, you should really look at this 3-month inflation, because this 3-month inflation is at 1.89, and so the Fed's already at target, and the Fed should ease immediately by 100 basis points because inflation is whooped. Well, that will get you into trouble because, inflation last month was 1.89% on a 3-month basis, and now it's 2.8. So if you were really relying on that 1.9, if you were reading anybody who was like, man, 3-month average, it's really low. Well, now you need to go back and read them again and see if they say, well, 3-month average is at 2.8. I was totally wrong. The Fed should probably keep tightening or stay on the sidelines. So just see if they totally changed their story. And it's one of the reasons that 3-month averages are really just a terrible way to go. And it's a bad way to run a railroad, as they say. 6-month averages, not much better. By the way, most of the people who are now talking about 3-month averages were talking about 6-month averages. And then because of base effects, the 6-month average started going up. They kind of all moved to 3-month average. So just, be suspicious of that kind of behavior. On this podcast, in my analysis, I will almost always do 2 things. Of course, I'll talk about the month-on-month numbers. Those are important. But I will focus on year-on-year changes, and I will focus on median instead of core most of the time. And again, I'll talk about the different things. But that is my forecast variable is year-on-year median CPI. And it's been that way for 10 years, and it's going to be that way for the next 10 years. So anyhow, let's get back to the actual figure. So I thought, and I said in the podcast last week, that one of the reasons we were going to be soft is because shelter should start to decelerate here fairly quickly, at least according to my model. Well, especially if we're focusing on year, you can't be that precise with which month is it going to start decelerating, and models just don't work that way. And this wasn't the month. Still over the next month or 2 or 3 months, at some point here, we're going to get a deceleration in rents. It's not going to deflation, but it is going to decelerate further from here and get to about 3% year on year. But that didn't happen yet. In fact, owner's equivalent rent printed 0.56% month on month. That's huge. That's a huge number, and it's a big jump for what is a big chunk of the CPI. And so that's a big part of the miss right there. And so what I said last week was look past shelter. If shelter is the reason that it's weak, the same goes for if it's strong. If that's the reason that the CPI was strong because of the owner's equivalent rent, then I would say, if the rest of the report was weak, I would tell you, and you know that if you've listened to these monthly reports for a while, you know that if there's one thing like that, I wouldn't sit there and say, I'm an inflationist, it's a strong number. I would say, outside of housing, it was kind of a softish kind of report. But that's not what I'm going to say today, because that's not true. Owner's equivalent rent was very high. Primary rents actually did decelerate a little bit. They had been like 0.39% last month. They were 0.36% this month. That's not the deceleration I was looking for, but it's at least the right direction. And so the owner's equivalent rent is really sort of an outlier. Lodging away from home, also in the shelter component, was up 1.8%. That was a big month-on-month figure I hadn't anticipated. Overall, the housing subindex was up 0.6% for month-on-month. But again, if this was all housing and everything else is weak, then, we look past it and we recognize that it's actually still a softish report. Well, so we look at core goods. That's the other thing that I sort of think that going forward, and not necessarily core goods jumps around a lot, so month on month, hard to say. But going forward, I think that, prior to COVID, we got very accustomed to core goods being always in deflation, a little bit of deflation. And that's one of the reasons we could get headline down to around 2%. Even though housing was typically higher and services was typically higher, was that we had this core goods deflation going on. Going forward, I don't think that we're going to continue with that. Last month, we'd seen year-on-year core goods go up and become positive. This month, it went back negative again year-on-year. And a lot of that was due to a large drop in used cars, which was down 3.4% month on month. And I've said in the past, that used cars had been curiously strong, right? I mean, my model has that they should be kind of going, being this sort of negative on a year-on-year basis for a little while yet here. At least that's what the private surveys are saying. And it had been strong recently. So today was a surprise to the downside. It dragged down core goods and kind of got back closer to the model for core goods. So, but core goods was definitely soft. Now, if you remember in the past, and I haven't talked about this for a while, I don't think, but one of the ways to look at inflation in a very sort of a very simple but routine, I guess, way is to break it into sort of 4 roughly equal-sized pieces. One of them is food and energy, which, by the way, both food and energy were adds this month, which is surprising, and I don't think a lot of people saw that coming. The energy in particular was expected to be a drag, but electricity had the biggest jump in years, and so surprising. But food and energy is one bit, and so that's the most volatile part, and it's a little bit less than a quarter. But by the way, if you hear that little ding ding in the back, that's a Bloomberg chat coming in. So a fan, I guess. So that's so nice. Nice people say nice things. Anyway, so that's the most volatile is food and energy. Then we go to core goods. That's the second most volatile. That's what I was just talking about. It's back in deflation, but it does tend to be volatile. I do think there's a story to this going forward. Obviously, this wasn't a month for it. So was this a soft report? Well, no, because then we go to the next more sedate is core services, ex shelter. Okay, that's super core. I'll come back to that in a second. And then we have shelter, which is normally the most tame, the most sedate, slow moving of the pieces. And I've already spoken about that. So let's go back. And by the way, actually, one more thing on core goods, and that is I'd mentioned used cars. Also in core goods is pharmaceuticals, medicinal drugs. They were also weak. So throw that into the core goods pile. Core services, the sort of so-called super core services, ex rent of shelter. So it's got a lot of stuff in there, and I've been saying that I would expect it would not fall very quickly because a lot of this, this is where the wages live. And although wages have been decelerating a little bit, the Atlanta Fed's wage growth tracker is still rising at 5% year on year. And now, of course, I don't think it's the case that, as Yellen said this week or last week, said that inflation's okay because wages are going up, so we got that going for us. No, that's not really the way that works, Janet. But it is true that wages are going up, and so they're rising. But because they're rising, they pass into inflation. That's that feedback loop. It's in core services. It's in the super core part, and so that that part, core services ex shelter, rose 0.85% month on month. That's the biggest rise in a couple of years, and the year-on-year measure is in an upswing, and a pretty clear upswing there. Part of that is because of health insurance, which, remember, was a drag for a long time, and now it's an add for these 6 months. But that's not it. That's not all of it. Hospital services, which is something that I had sort of missed until a couple of months ago, how much it had been accelerating. But hospital services in this report rose to 6.7% year on year, which is the highest year on year rate since 2011. Doctor services is now kind of getting close to positive, and I would not be surprised to see doctor services, also physician services, start to rise as well. But it honestly has been, if you think about the fact that we came through COVID, it was astonishing, and I said it over and over during COVID, that I don't understand why medical care is not rising more quickly than this. But hospital services are now rising at a pretty rapid rate, and that makes perfect sense to me. So that's what's going on here. You've got the core goods maybe look kind of good, but everything else in this report, owner's equivalent rent, people will be distracted by that huge number. But it wasn't just that. The super core part is also pretty ugly. And so those people who thought that inflation was settling gently back to target and that the Fed can go ahead and, cut 25, 50, 75, 100 and quickly get back to 2% for some reason, why they'd want to do that when neutral is like 3.5 to 4, I don't know. We're not in this free fall recession or anything. I think you'd want to keep your eye on the ball. But the people who said, "Oh no, we've already licked inflation, so we can get rates back to neutral quickly, and then probably start to ease into the recession," this report does not give you any help. This definitely takes a Fed ease in March off the table. We're going to get one more CPI. It would have to be a devastatingly bad CPI. Crazy soft number to have the Fed even consider easing in March, especially because they keep saying that they are going to hold higher for longer. I don't think there's a chance. I don't think there's much of a chance they're going to go in May. Look, there's always disasters can happen. You could have a market crash. You could have a terrorist attack. You could have. There's all kinds of things that could happen. Banks fail or something. You could always have something happens that causes the Fed to ease. But on the basic trajectory that we're looking at, which is softening growth, okay, fine. But inflation that's not really softening as fast as people want it to, there's just nothing there that says that the Fed needs to ease right away. And so I certainly would not be looking for it for any time really soon. I continue to see, and by the way, I said median is my forecast of variable median and CPI, and I haven't mentioned it yet. Median CPI was up 0.53% month on month, which is the highest since last February. And so it's at 4.9% year on year. I still think that's going to get down to the high 3s, low 4s before it sort of, and I think it's going to be really hard to get below that. Chance we could get it slightly lower than that if housing really does decelerate faster than it has done so far. If it goes down to where my model says it's going to be, then we could get something a little bit lower than that in median temporarily before we head back higher. But it does not. There is no sign that I can see that we're about to have median inflation back to the 2s. I just don't see that happening anytime real soon. But hey, there's a lot of game left to be played, as they say. So, that's where we are today. But next month maybe used cars drops another 3%. Maybe hotels lodging away from home plunges. Maybe owner's equivalent rent reverses. Some weird seasonal or something. You could get a really weak number. Haven't gotten to forecasting it yet, but on the basis of where we are, don't hold out hope to have the Fed come and bail you out. I'm sure there will be somebody will come up with a reason this is bullish for stocks, but I can't think of why it is. Anyhow, that's all for today's brief CPI summary podcast. If you do like it, and again, I've gotten some nice comments on this. Please refer this to others. Send on the link. Tell people they should be looking at this. Please like it. Subscribe to it, of course. You can also look. I write about this in the blog as well, inflationguy.blog. So that's free. So you can get this in sort of a written form. Or you can wait for the podcast if you like that. You can follow me on X at inflation_guy, where all these things get released as well. But I like to have the actual subscription rather than having you follow me on Twitter. Visit Enduring Investments if you have an inflation challenge. And most importantly, never forget, defend your money. And if inflation is coming for you, remember,